So how does a company account for its investments in debt securities? Well, at the time that you acquire that bond or note that you are buying from another company, you would record it on your books as an asset. And that asset would remain on your books for the entire mature life of that investment until its maturity date or the last date of the note rolls around, in which case you would remove it from your books. But when you invest in another company's debt, you not only get repaid at the end, you get a series of periodic payments from that company as their thank you for letting them essentially borrow money. And that is recorded as interest, and since our company is going to be the one receiving it, we're going to record it as interest revenue. The journal entry for the purchase of a debt security is always the exact same thing. It is a debit to the investment that you are making and a credit to the method for which you are paying to acquire that investment. So Smart Touch Learning has excess cash to invest and they want to buy a bond. They could pay $100,000 to buy a $100,000 face value, 9%, 5-year bond from Neon Company. These bonds are going to pay interest semi-annually, which is normal for bonds, twice a year. And Smart Touch plans to hold the bonds until maturity. Well, that last line is very important because we classify our investments in debt on our books based upon our intentions. So since we're planning on to hold on to this bond for the entire 5-year life, it is going to be held to maturity. We'll call it a held to maturity debt investment. So we debit held to maturity debt investments for the face value of the bond that we are buying. In this case, it's $100,000. And we're going to assume, because it's typical that when we are buying this bond from another company, we are essentially just letting them borrow money from us. And therefore, we need to decrease our cash account by crediting it for that same $100,000. And then periodically, over the life of the bond, the investee, the company that we've invested in, is going to be obligated to send us a series of interest payments. Well, you find the amount of interest you are going to receive by using the same formula over and over again. You take the face value of the bond which you own, you multiply it by its stated rate of interest, but that stated rate is always for a year, so you need to convert it to the amount of time that has passed since the last time you received interest payment by multiplying it by the number of months since you were last paid over 12. So for this bond that Smart Touch owns in Neon Company, it pays interest semi-annually. That's every 6 months. So the formula they're going to use is $100,000, the face value, times 0.09, the stated rate of interest, times 6/12, and that comes out to be $4,500. That is the amount of payment that Smart Touch is going to receive from Neon Company. Well, they're receiving the payment, which means their cash account is going to be going up, and cash always goes up with a debit, so we debit cash for $4,500, and our credit is to what we did to receive that cash. Well, we let them borrow money once upon a time, and now they are paying us interest. So the credit in this case, whenever you receive interest on a bond investment, is going to be to interest revenue, $4,500. And then Smart Touch, assuming that they were going to hold on to this bond for its entire 5-year mature life, actually does so. And at the end of that 5-year life, on June 30th, 2023, this bond becomes mature, which means Neon is obligated to repay Smart Touch Learning the $100,000 that they invested 5 years ago. They're paying back that initial investment of $100,000, which means Smart Touch's cash account is going to be going up by a substantial amount. We're going to debit cash for the face value of the bond, $100,000, and this bond is now mature, which means it has no value. There's no series of interest payments. There's no repayment going to happen in the future. It's no longer an asset to us, which means we need to take that asset off of the books, and we do so by crediting held to maturity debt investments for $100,000. And if you are the type of person that likes to write in shorthand, like I am, making journal entries, I just call that HTM debt investments for held to maturity. So let's run through another example here, and we'll say on January 1st, 2018, McFly Motor Company is going to invest their excess cash by purchasing a $12,000 bond from Tannen Gaming Company that carries a stated rate of 6% and has a mature life of 4 years. McFly is planning on holding on these bonds until maturity. So since, again, we need to state our intention at the time we put the investments on the books, we're going to record this as a held to maturity, or HTM, debt investment. And we put it on the books for face value, which is $12,000. And then we are letting Tannen borrow that money, which means we need to decrease our cash account by that same $12,000. And the journal entry to record our investment in Tannen Gaming Company's bonds. Next up, Tannen is going to have to send McFly a series of interest payments, their first payment in a series. And that's going to happen on June 30th, assuming that Tannen's bonds pay interest semi-annually. 6 months have passed. So we use face times rate times time. The face value of these bonds is $12,000. The stated rate of interest is 6%, and since it's paying semi-annually, we use 6 out of 12 for time, and 12,000 times 0.06 times 6 twelves equals $360 that our company, McFly, is going to be receiving from Tannen. Well, since we're receiving the cash, we need to debit cash to increase the balance of our cash account by that $360, and we will record that as interest revenue for that same $360. And the journal entry to record the receipt of an interest payment from a company that you own a bond in is always going to be that. It's always going to be a debit to cash and a credit to interest revenue. The only thing that's really going to change is the amount you are receiving, and it's always found by that same formula, face times rate times time. Then we'll say on January 1st, 2022, McFly Motor Company disposes of the fully mature, very important, $12,000 face value, 6% 4-year bonds, which they had previously purchased from Tannen. And we're going to assume that all interest payments have been made on these bonds that we have, which means we just need to take them off of the books at their maturity date. Well, we need to take it off the books because Tannen is repaying McFly the $12,000 that they essentially let them borrow when they issued the bond 4 years ago, which means McFly, whose company we are accounting for right now, is receiving the cash. So we need to increase their cash account by $12,000, and those bonds which they held in Tannen are now mature, and therefore they're not worth anything. They're no longer an asset. So we need to credit held to maturity debt investment for that same $12,000. In the journal entry to record the disposition of these bonds at their maturity. And as a side note over here, let's do the same setup that we had before, but let's change one very important factor. On January 1st, McFly Motor Company is going to invest excess cash by purchasing $12,000 worth of 6% 4-year bonds from Tannen Gaming Incorporated. But this time, McFly is unsure if they will hold these bonds until maturity. Well, the credit in this entry is still going to be exactly the same. We're still letting Tannen have $12,000 in cash by issuing us these bonds. But now, since we're unsure if we're going to hold these bonds to maturity, we shouldn't classify this as a held to maturity or HTM debt investment, because we don't think it's more probable than not that we're going to have it for the entirety of the 4 years. But we're not going to classify this as trading debt either, because we believe it's not our most probable situation that we're going to dispose of these bonds the first chance we have to make a profit. We do not know. And when you do not know if you're going to hold it to maturity or sell it at any point, if you don't have a certain outcome that you are expecting, you classify it as an AFS debt investment, or available for sale debt investment.